Picture this right now. A Falcon 9 rocket is going vertical on the pad. The countdown hits 0, the engines roar to life, and a massive exhaust plume spreads across the Florida sky. It is majestic, right? The crowd is going absolutely insane. What you are watching is literally human progress happening in real time. But hold on, let's hard cut to a completely different scene. Picture a trading floor or even just your buddy's living room. Regular retail investors are staring at glowing red screens, watching their portfolio values absolutely crater. Now, it's the exact same intense energy, but totally in reverse. Welcome to this Galvix Economics Explainer. Today, we are going full forensic breakdown on the highly anticipated SpaceX IPO story. Let's get one thing crystal clear right from the jump, because we have to be fair here. SpaceX is an incredibly historic, genuinely impressive company. What they have pulled off with rocketry and Starlink, it's mind-blowing. No one is taking that away from them. But here's the brutal reality of the market. Genuinely impressive companies can still be absolutely terrible investments for regular people. So, as the IPO chatter really heats up and your uncle starts texting you about buying the dip on launch day, you need to sit down and hear this out, because the game, it is already being played. And if you buy this IPO on day one, you are actively being set up to hold the bag for billionaires who are just looking to cash out.
To truly understand the trap that is being laid out, you first need to understand one absolutely crucial concept. We call it exit liquidity. Now, in American financial slang, when early private investors, the venture capitalists, the insiders, want to turn their massive paper wealth into cold hard cash, they have a problem. They need someone to actually sell their shares to. They need an exit. And you, my friend, the everyday retail buyer caught up in the hype, you are that liquidity. In a perfectly fair market, both sides kind of know what they're buying and selling, right? But in a massive hype-driven IPO, the timing is artificially engineered, the information is completely lopsided, and the retail buyer is systematically disadvantaged from the get-go. As the old saying goes in the giant Wall Street casino, if you look around the poker table and you can't figure out who the mark is, it's you. And in this upcoming scenario, Wall Street is hoping you don't figure that out until it's way too late.
So how exactly do we get set up as the mark? Well, to understand that, we kind of have to split our brains into two completely different halves. On one side, we have what I like to call the romantic narrative. It is an incredible, intoxicating story. You have a visionary entrepreneur who bets his entire fortune on a scrappy rocket company. They achieve the impossible with reusable boosters, they build the massive starship, and the ultimate goal is literally saving humanity by colonizing Mars. It's dazzling. You want to believe in it. But on the exact opposite side, we have the cold, hard business reality. Strip away the romance, and what are we actually looking at? We are looking at a hyper-capital-intensive business that crossed about $9 billion in revenue in 2023. A business that burns through massive, eye-watering amounts of cash, operating in quite literally one of the most expensive and unforgiving industries on planet Earth. The romantic narrative is the shiny object you see in the media. But the business reality, that is the actual balance sheet you'll be owning shares of.
I want you to anchor yourself to a single, staggering number right now. $350 billion. That's a 3, a 5, and 10 zeros. That is SpaceX's most recently reported private valuation as of mid-2024. Let that sink in for a second. We are talking about $350 billion for a company that, in its entire 22-year history, has never reported a sustainable net profit as a standalone public entity. They are burning through billions of dollars on capital expenditure just to keep the lights on and the rockets flying. Yes, absolutely, they are growing fast, no one is denying that. But $350 billion is a price tag that doesn't just imply a good business. That price tag implies absolute, flawless perfection for decades to come. Keep this massive number in the back of your mind as we keep peeling back the layers of this onion.
To really grasp just how wild, how completely inflated the $350 billion price tag is, we need to talk about something called revenue multiples. Basically, how much are investors paying for every dollar a company brings in? Let's look at the heavyweights. Amazon, arguably one of the greatest cash-generating machines in human history, trades at roughly 3 times its revenue. Tesla, a massive, highly profitable company run by the exact same founder, trades at about 7 times its revenue. Microsoft, a total software juggernaut, is sitting at 12 times. Okay, but what about SpaceX? At a $350 billion valuation on roughly $9 billion in revenue, they are trading at an implied 39 times revenue multiple. 39. That implies a level of future growth and margin expansion that literally dwarfs almost every precedent in the history of public markets. You are paying a massive, astronomical narrative premium before you even get a seat at the table.
So let's break it down. Where does that $9 billion in revenue actually come from today? I'll tell you right now, it's not from science fiction, it's not from Mars real estate. The actual, real-world business model has 3 main buckets.
First up, you have launch services. This is the bread and butter of selling rocket rides to put commercial satellites into orbit. Second, you have Starlink, the satellite internet constellation. This is the big growth engine, making up about $6 billion of that total revenue pie. And third, you have U.S. government contracts. We are talking massive payouts from agencies like NASA and the Department of Defense. This is the real business, folks. When you buy this stock, you aren't buying a futuristic ticket to a Martian colony. You are buying an internet service provider and a heavy-duty government defense contractor.
Let's zero in on Starlink for a minute, because that specific division is the main engine driving this completely insane valuation. A lot of folks out there like to treat Starlink like it's a high-margin, asset-light software company, like it's an app you just code once and sell 1,000,000 times. It is not. It is what we in economics call a CAPEX treadmill, capital expenditure. Let's do the math. There are currently over 6,000 Starlink satellites floating around in low Earth orbit. Each single one of those satellites has a maximum lifespan of about 5 years before it falls out of orbit and burns up in the atmosphere. That means SpaceX has to physically replace roughly 1,200 satellites every single year, and they cost anywhere from $250,000 to $500,000 each. You do the math on that. That is hundreds of millions of dollars a year in continuous, unavoidable, physical capital expenditure just to maintain the current network before they even think about real growth. That is a brutal treadmill to be running on.
Now, I want you to watch exactly how the trap was set over the years. Look at how the early institutional guys, the so-called smart money, pumped this valuation up to the moon. Back in 2015, private investors were getting in at a cool $12 billion valuation. 4 years later, in 2019, they pumped it to $33 billion. In 2021, during peak zero interest rate euphoria, it hit $74 billion. And now, magically, $350 billion in 2024. In just 9 years, the private valuation of this company went up 30 times. Did the actual revenue go up 30x? Absolutely not. Did the profits? Not even close. What went up was the story, the narrative. These massive sovereign wealth funds and elite venture capitalists are sitting on extraordinary, life-changing paper gains right now. But here is the kicker. They can't turn that paper into a new yacht until they sell it to someone else. And guess who that someone else is going to be?
Let me walk you through exactly how this builds into the pure mechanics of a Wall Street heist. It's a playbook, and they run it every time. Step 1. The massive investment banks secure hundreds of millions of dollars in fees simply to hype the deal up and take the company public. Step 2. Institutional investors, the big boys, get allocated shares at the official, relatively lower IPO price. Step 3. The market finally opens to the public and day one retail FOMO completely takes over. Fear of missing out spikes the price massively on the open market. Those institutional guys, they can flip their shares instantly for a massive risk-free profit. And finally, step 4, a few months down the line, the legal insider lockup period expires. This means the really early investors are finally allowed to dump their massive holdings onto the open market. And the retail investor who bought the top gets absolutely crushed under an avalanche of supply.
So, the absolutely crucial point to understand here is the extreme, almost comical information asymmetry between the sellers and the buyers. Think about the sovereign wealth funds that are going to be dumping this stock onto you. They've had access to highly detailed, completely non-public financials, exact internal cost structures, and direct face-to-face management access for years. They know where every penny goes. Now, what do you, the retail trader FOMOing into the stock on your phone, get? You get an S1 prospectus that has been heavily massaged by an army of corporate lawyers. You get an absolute avalanche of breathless media hype, and you get a bunch of celebrity tweets telling you it's going to the moon. You are essentially stepping into a professional boxing ring blindfolded while the guy you are fighting is wearing night vision goggles. It is not a fair fight.
Now, if you think I'm just spinning some overly bearish theory here, I promise you I'm not. This is a repeating, documented historical pattern. Just look at the hard data from massive tech darlings like Uber, Lyft, and Rivian. Uber went public at $45 a share, it didn't even get the expected first-day pop, and it bled out to $25 within 6 months. Lyft? The hype was huge. It popped to $88 on day one and then crashed all the way down to $30 within a single year. And Rivian, the EV truck company, they went public on absolute peak market hype. Retail buyers pushed the stock all the way up to $172 on day one. By late 2022, it was trading under $25. In every single one of these cases, the early venture capitalists locked in multi-generational fortunes, while regular, everyday folks who bought into the shiny narrative were left holding a heavy, empty bag for years.
What's really wild about this whole situation is that the $350 billion price tag currently assumes literally zero bumps in the road. Perfection is priced in. But we have to look at the unpriced bear case, the stuff no one is talking about. First off, Starlink is facing intense, extremely well-funded competition. Amazon's Project Kuiper has committed $10 billion to building out its own satellite network. Satellite internet is absolutely not going to be a monopoly. Second, Starship's development timelines have slipped repeatedly. Space is hard, and delays cost money. And third, as regular, high-speed fiber optics and 5G networks continue to expand globally, Starlink's actual addressable market for expensive, dish-based home internet actually starts to shrink. It gets boxed out. None of these very real, very serious competitive threats are baked into that euphoric $350 billion valuation.
And then we have to talk about the ultimate hype multiplier. I call it the Mars Myth Premium. We are consistently, relentlessly sold the narrative that SpaceX is going to establish a self-sustaining human city on the surface of Mars by the year 2050. Listen, as a human being, I think it's an incredible goal. But as an investor, Mars colonization is not a business. It has absolutely no current revenue model. Who is paying for the real estate? Who is buying the exports? It doesn't exist. Yet, Wall Street uses this vague, futuristic optionality to bake a massive, almost unquantifiable premium into today's stock price. When you buy at the IPO, you aren't actually buying a functioning Mars company. You are paying a massive, massive surcharge for the fairy tale that they might become a Mars company in 25 years. You are literally paying for science fiction using today's real, hard-earned dollars.
We also need to unpack the complex political and regulatory risks, and we are going to look at this totally neutrally, just as financial analysts. SpaceX is extraordinarily dependent on the United States government. NASA and the Department of Defense make up a huge, critical chunk of their revenue. This creates major vulnerabilities for the business. Right now, you have FAA licensing bottlenecks that are actively slowing down the Starship testing cadence. You have the reality that Starlink has been utilized in active global conflicts, instantly making SpaceX a major geopolitical actor on the world stage. And you have a high-profile founder who now heavily navigates complex government advisory roles. Regardless of where you personally fall on the political spectrum, as an investor, you have to realize that heavy reliance on government contracts means a simple change in political winds can directly and severely impact the company's bottom line. That is a massive risk factor.
So you might be wondering, why don't you hear about these risks on the evening news? Why is it all just rocket emojis? It all comes down to the financial media's role in manufacturing consent. Media outlets operate on one thing: clicks. And a breathtaking, high-definition video of a rocket landing backwards on a drone ship, that gets clicks. A boring 30-page spreadsheet analysis of CapEx depreciation schedules, that does not. Furthermore, there's a huge issue with access journalism. Reporters know that if they write heavily critical, deeply bearish pieces about the financials, they probably aren't getting invited to the next exclusive Starship media junket at Starbase. So the media environment systematically amplifies the exciting bull case and quietly hides the boring bear case. They end up acting as a giant unpaid megaphone for the Wall Street IPO hype machine.
So the absolute core takeaway here is a fundamental economic lesson that you have to burn into your brain. It is the critical difference between value and price. Value is what the company is actually worth in reality. It's based on its future cash flows, its actual competitive position in the market, and its real-world risk profile. Price, on the other hand, is simply what the market is asking you to pay right this exact second. And in an IPO, that price is driven by narrative, by FOMO, and by that structural information asymmetry we talked about. Just because the ticker on the screen says the price tag is $350 billion absolutely does not mean that is the intrinsic value of the business. In markets that are completely hijacked by hype, price and value completely disconnect from each other. And unfortunately, it's almost always the retail buyer who ends up paying the difference out of their own pocket.
So what do we do about this? What is your ultimate actionable defense mechanism against this rigged game? How do you make sure you don't become someone else's exit liquidity? You use what we call the 12-month rule. It's simple, but it takes discipline. Step 1, skip the IPO entirely. Totally ignore the day one pop, turn off the financial news, and just sit on your hands. Step 2, wait the standard 90 to 180 days for all those insider lockups to expire. Let the market absorb all those millions of shares being dumped by the early investors. Step 3, wait a full year so you can finally evaluate 4 actual quarters of public, heavily scrutinized SEC financial data. No spin, just the raw numbers. If the company is genuinely growing into its massive valuation, you can buy it then, and you'll usually be buying it at a much safer, significantly more rational price.
Which brings us to our final, most important thought of this whole explainer. You have to realize that the technological mission of a company, and the financial reality of an investment are two completely separate things. America's future in space does not depend on you, a retail investor, buying wildly overpriced shares on day one of an IPO. You can believe wholeheartedly in the incredible, world-changing mission of SpaceX while absolutely refusing to provide exit liquidity for venture capitalists looking to cash out. The rockets, they are amazing. The company, it is a real, historic enterprise. But the entry price they are going to ask you to pay, it's a trap. SpaceX might very well reach Mars one day, but if you buy the absolute peak of the IPO hype, will your portfolio survive the trip? Thanks for joining me on this Galvix Economics Explainer. Keep your eyes open, read the S1 prospectus when it finally drops, don't let the FOMO get